Report that's come out from the House of Credit Suisse, where they are tracking India's corporate health, talking about how the credit challenges remain and the franchise businesses are driving value accretion. Joining in to chat a little bit more about this report and elaborate on the findings is Ashish Gupta. He's head of equity research at Asia Pacific Credit Suisse. Thanks so much for joining in. Ashish, let's first up talk about that threat, the combination of high leverage and low interest coverage. How much of a threat to it is it, especially at a time when we are seeing an all-round slowdown? Does the effect of this get compounded?
Sure. Hi, good morning. Yes, so I think this health tracker is something that we have been running with for the last 6-7 years. And to be frank, the readings on this health tracker have been pointing to elevated stress now for multiple years. But what we have recently seen is that overall the corporate profitability growth has taken a dip this quarter. Aggregate EBITDA growth for corporate India came down to 6% and aggregate interest cover dipped further. And what was disappointing was that after several quarters of stable level of stress, so while the stress level was elevated, at least it was stable, we saw an increase in overall stress indicator. And as you might have seen in the report, the primary indicator we use is number of corporate that are running with interest cover less than 1. And the big delta this quarter came from sectors like power. As you may have seen news reports, power demand has been weak and PLFs for many of the power producers have come down, and therefore the interest cover for power companies dropped. And the other much talked about sector, of course, is telecom, where most of the companies in our sample had interest cover less than 1. So that stress level continued to build up. The other big challenge that we are seeing today is that the financing markets are very tight. And particularly from a bank credit quality point of view, this has two implications. One is that some of the non-bank exposures that they have, they are likely to turn non-performing because of credit availability being limited to the NBFCs. And the second is that the poorly rated corporates are finding it difficult to get incremental credit and refinance. And therefore, you are seeing increasing incidence of default there. So both these challenges put together are leading to increased corporate stress.
Ashish, banks with excessive capital are aggressively slashing deposit rates. What will be the impact of low LDRs, and how is it, do you think it's going to impact NIMs and profitability thereof?
Sure. So over the past 6 months in particular, we have seen a big turnaround in the total liquidity availability in the banking system, and in particular private banks. As you know, private banks was one pocket of banking system that was rapidly growing over the last 3 years, taking market share from state-owned banks, and the big constraint for them was only the amount of deposits that they could garner. And these banks were paying a large premium on term deposits to state-owned banks to get more deposits. But lately, both on account of the slowdown in loan demand in certain consumer segments, as well as increased risk averseness, we have seen even for private banks the loan growth rate come down, and they are now carrying excess deposits. So some of the largest private banks are carrying $7-8 billion of excess deposits, which in the near term are going to weigh on NIMs. while there is good amount of pricing power on loans, what you are unfortunately seeing is that the loan deposit ratio will be coming down, and as you know, the surplus funds are deployed in negative carry instruments. So either they are deployed in G-Secs or parked with the RBI, which leads to a pressure on NIMs.
And can you tell us a little bit about how we're seeing all of this stake sale in the distribution and non-lending business like SBI Cards? How is that going to help the capital provision position and the valuation for HDFC and SBI as well?
Sure. So unfortunately, I would not be able to talk on specific companies and stocks, but in more of a broad way, I can highlight to you that most of the large franchise banks in India have very meaningful subsidiary businesses. They range from life insurance, general insurance, asset management, and of course one of them also has a credit card subsidiary. Over the last 24 months, we have seen many of these businesses already being listed. And because these are less capital intensive businesses and all these companies continue to gain market share, you are seeing the market giving them very healthy multiples. And most of these companies actually today trade at multiples which are higher than of the parent company. And what we have highlighted in the report is that while some of these stocks have been strong performers over the past 12 months, a lot of the stock price movement can actually be explained by the value accretion in the subsidiaries. And therefore, if we look at the core banking franchise, that is still very attractively valued.
Okay. What's the overall systemic risk then, according to you, when companies like Tata Steel, JSPL, Adani, they struggle with deleveraging and lack of growth in EBITDA? How long does the deleveraging cycle get delayed?
Yes, so I think the macro outlook therefore does get muted. The deleveraging cycle, unfortunately, will continue for the foreseeable future, and this will also weigh on the investment demand. In fact, the financing market tightness that I mentioned earlier is leading to a further pullback even in the some of the investment plans of the mid-sized companies. So frankly, I don't have a timeline on when we kind of see a turnaround, but this is a cyclical process, right? So all business cycles run similarly. At this point of the cycle, the only thing that will happen is that you will see RBI continuing to cut rates, liquidity being built up, that bringing down lending rates. And as more and more surplus liquidity is available, at some point of time, you will see banks starting to lend a bit more aggressively, being willing to go to a bit more lower tiered borrowers, as well as easy availability of funding driving some of the investment capex. But a cycle does take time to play out.
Ashish, on the subject of telecom, which also is plagued by this AGR due and the geo effect, 100% of the telecom has interest coverage less than 1 times. The private debt to telecom is about 1.8 trillion and the government debt is also pretty high. Deleveraging here also seems to be a challenge unless a fair bit of capital can be raised. What are your thoughts on the same?
So I think this is one space that has seen a lot of positive news, and really the fundamentals have dramatically improved over the last couple of weeks when aggressive price increases have been undertaken, and that will lead to a substantial step up in the profitability and EBITDA of these companies. I think the challenge, though, in the near term remains that there are immediate cash flow needs. Hopefully, there will be some affirmative government action on that front as well. You might have some pushback in the terms of payment for these AGR dues. And if that happens, I think then at least the top 2-3 players who are still standing, I think they will be in a much better position, and hopefully that will not be a part of the portfolio that banks will need to worry about.
The power sector, of course, seems to be a sore point. Overall, PLFs have seen declines even at the private level, and merchant tariffs are also falling, while demand has softened considerably. So what lies ahead for the power sector? Any light at the end of the tunnel?
The only light is that finally, after 2 years of trying, we are coming to the end of a few resolutions. So a couple of power projects are getting resolved. They are finding new buyers. So there are 2-3 that should be completed by the end of this quarter. And that will bring down the NPA level for the few banks that have exposure to these names. Of course, these are coming with stiff haircuts. The haircuts would be in the range of 40 to 60%. But over the past 3 years, banks have built up adequate provisions on these already. So while there will be large haircuts, we don't expect this to lead to incremental provisioning needs. But for the broader power sector, I think the challenges remain, so you may have seen the reports from some rating agencies. The concern has kind of moved on from just the thermal power projects to some of the renewable projects as well. So this space, I think, will continue to be a sore point for the banking system.
Joining in, you've given us an overall view on what the overall environment is like, the systemic risk for different sectors, as well as the outlook on telecom. Ashish, good chatting with you.